Right now, Rezolve AI PLC, ticker RZLV, is trading at $4.91, up about 0.82% on the day. And the first thing you need to know about this company, the thing that likely isn't showing up on your standard stock screener, is that this $1.5 billion AI commerce company has also announced a $1 billion Bitcoin-backed treasury strategy. Yes, you heard that correctly. It's an AI play that is simultaneously making an enormous leveraged bet on a completely separate and exceptionally volatile asset class. This is the kind of detail that changes the entire story, moving a stock from one category, small cap AI, into something far more complex and, frankly, far more dangerous or potentially brilliant, depending on your perspective. It's a layer of reality that the surface-level expectation just doesn't prepare you for, and it's why so many traders are getting this one wrong. The general belief, the broad market expectation, is that Rezolve AI is a straightforward ground floor opportunity in the artificial intelligence sector. You see the ticker, you hear AI, you see they just reported a 426% year-over-year revenue increase for the first half of 2025, and you see they have major strategic partnerships with both Microsoft and Google. The narrative writes itself. This is the kind of stock people surfing on their Robinhood app or checking their SoFi Invest account are looking for, dreaming it might be the next Nvidia stock. The expectation is that you buy it, hold it in your Fidelity brokerage account, and wait for those Google and Microsoft sales channels to mature and turn this into a 10-bagger. The company itself is feeding this expectation, guiding for a $150 million annual recurring revenue exit rate for 2025 and a massive $500 million ARR target for 2026. These are explosive numbers that scream buy. But then reality hits. The expectation of a smooth ride to AI riches collides with the facts on the ground. The reality is that Rezolve AI is one of the most volatile and controversial battleground stocks on the market today. Let's start with the recent movement. While the 6-month chart shows a parabolic surge of over 300%, the last 30 days have seen the stock collapse by more than 25%. This isn't the stable upward climb of a blue chip like Apple stock. This is the gut-wrenching volatility of a high-stakes narrative stock. This is not a security you just add to a passive Schwab Intelligent portfolios and forget about. This is a name that requires daily attention, a stock that active traders using platforms like Interactive Brokers are battling over. The reason for this recent drop is the disconnect between that flashy ARR guidance and the cold, hard numbers. When the company reported its Q2 2025 earnings, its actual revenue came in at $4.88 million. That was a miss of 27.7% against the forecast of $6.75 million. Think about that. The company is guiding for $150 million in ARR, but just printed a quarterly revenue number under $5 million. This is the central tension of the stock. The company's management addressed this directly on their earnings call, stating that there is a 7 to 9 month lag between booking ARR and that ARR converting into recognized revenue. So the bull case, the expectation, is that the $6.3 million in first half revenue is just the tiny leading edge of a massive wave of sales that will start hitting the books in 2026. The bear case, the reality that has traders spooked, is that the ARR guidance is just that. Guidance. It's a projection, not a guarantee. This exact disconnect is what attracted a short seller report from Fuzzy Panda Research back in September, which alleged the company was overstating its capabilities. Rezolve's management categorically rejected the report as misleading, but the damage was done, and it planted a seed of doubt that the recent revenue miss only amplified. This stock is now a show-me story. The market is no longer taking those massive projections on faith. What's fascinating is how the market is struggling to price this. On the day of that Q2 earnings report, despite the massive revenue miss, the stock initially surged 21% in pre-market trading. Why? Because the company met its earnings per share, EPS, of minus 0.03 cents, and, more importantly, it strongly reaffirmed that 150 million ARR guidance. This tells you everything. The market is currently ignoring the present reality, the revenue miss, and trading entirely on the future expectation, the ARR guide. This is a recipe for the kind of volatility we've seen. Traders on platforms like SoFi, Robinhood, and other investing sites are piling in on the AI dream, while more cautious managers at places like Fidelity Investments are likely looking at the cash flow statement and feeling nervous. The company is predictably not profitable. It posted an adjusted EBITDA loss of $17.7 million. To fund this growth and its aggressive acquisition strategy, it recently bought Subsquid and SmartPay. Rezolve just closed a $200 million oversubscribed financing round in late September. This was absolutely critical. It shored up the balance sheet, bringing its cash position to around $230 million, giving it the runway to try and bridge that 7 to 9 month gap and prove the ARR is real. So, who is on the other side of this trade? If retail is nervous and short sellers are circling, who is buying? This is where the story gets even more compelling. The institutions are buying. In September, Rezolve announced that institutional ownership had surpassed 10%. And these aren't small shops. We're talking about new positions from some of the biggest players in the world: Citadel, BlackRock, and Vanguard. This is the core of the bull argument. You can debate the short seller report, you can worry about the revenue lag, but when you see names like BlackRock and Citadel taking stakes, you have to ask what they see. They aren't looking at the Robinhood stock charting charts, they're looking at proprietary data, management interviews, and the deep technical details of the partnerships. They are using their sophisticated interactive brokers platforms to build a position, betting that the bears are wrong and that the revenue is coming. Furthermore, insiders themselves own a massive 37% of the company. This is a significant alignment of interests. Management isn't just collecting a paycheck, their wealth is tied directly to RZLV's success. With all this financial drama, it's easy to forget what Rezolve AI actually does. The company's core product is its Brain Suite, an AI commerce platform built on its own proprietary large language model called BrainPower. Unlike a general-purpose model, Rezolve's AI is trained specifically for e-commerce, and the company makes a strong claim that its model achieves zero hallucinations, which is a critical feature for enterprises that can't afford an AI to make up product details. Its tools are designed to be embedded in a retailer's existing app or website to power things like visual search, take a picture of an outfit, find it in the store, conversational commerce, a chatbot that actually guides you to a purchase, and optimizing checkout. They already have over 100 enterprise customers, including major global brands like H&M, Ferrero, Crate & Barrel, and Myntra. This is where those Google and Microsoft partnerships become so important. They aren't just press releases, they are strategic go-to-market agreements. Google Cloud and Microsoft Azure are now actively reselling Rezolve's Brain Suite to their own massive lists of retail customers. Rezolve's management has stated they expect these two channels to generate more than 50% of their revenue forecast in the coming years. This is the catalyst. This is what the bulls at Fidelity and Citadel are betting on. This brings us to the future outlook and that Bitcoin-sized elephant in the room. The entire investment thesis for RZLV rests on the expectation of flawless execution. The bull case is clear. The $200 million in cash provides the necessary fuel. The 7 to 9 month revenue lag proves to be accurate. The Google and Microsoft partnerships accelerate adoption, and by mid-2026, the company is printing massive revenue numbers that validate the 500 million ARR guide. They successfully integrate their SmartPay and Subsquid acquisitions to build a true agentic commerce, and the company achieves its goal of operating profitability in the first half of 2026. If this happens, the stock will not be at $491 for long. The analyst consensus is a strong buy, with 6 to 8 analysts covering it, and price targets sit in a range from $7 all the way to $15. Those targets are based on the expectation that the ARR guidance is real. Now the bear case, the reality that investors must confront. The first risk is execution. The 7 to 9 month lag is a black box. If it turns out to be 12 months or 15, or if the ARR conversion rate is lower than hoped, the company will burn through its $230 million in cash and be forced to dilute shareholders again. The revenue miss was a serious red flag. The second risk is the short seller claim. What if the technology isn't as sticky or effective as claimed, and the competition from other AI platforms heats up? But the biggest